All right, guys, welcome to a brand new video. If this is your first time, please welcome. Make sure to grab a soda, beer, whatever you like to drink, and sit tight. Today, we're going to be breaking down ADR, right? This is going to be one of my most beloved concept, I should say, because I'm also going to talk about the pyramid array matrix, which is essentially all the array that I utilize within the Arcane concept library, or think of it like my pyramid concept matrix or my pyramid concept library, and then add more concept down the line onto the list of this model, perhaps. But as for now, over the last 5 years, 4 years, give or take 4 years and a half, these are all the concept in the organization I was able to find to be able to give you this so you understand what's in my head. Because here's the thing. I mean, I truly believe I have some of the most consistent and then objective model out there. But if I'm not able to give this to people in a way where they can understand, then it doesn't really matter. It's just something that's in my head. And it's like, you see someone that's on the street talking and just talking and talking, and you're like, what's going on with that guy? You got to be able to put it out there so people can actually understand what you're talking about. So in today's video, we're going to talk about the ADR. Think of this as the premium and discount concept for my Arcane concept library in parallel to the ICT dealing range that you essentially identify the trade where you're looking to trade discount and premium and so on and so forth. If you want to understand how to trade premium and discount or trade continuation, usually you want to understand where is the range that you're trading from, right? So the ADR, which stands for Arcane Dynamic Range, will be the range that we'll need to identify. And that range is extremely specific in the way that it is defined. For this, you really need to pay attention because it is one of the foundational concepts that will be utilized down the line to be able to trade, let's say, order block, breaker block, unicorn breaker, or like I like to call it, arcane breakers, and then a bunch of other concepts. But everything that I will teach in these libraries of concept build on top of the previous concept. Okay, let's go ahead and talk about this, right? One of my favorite concept, QSH, QSL. What is QSH and QSL? QSH and QSL is going to be the foundation, the very first concept that if you don't even master this, don't even worry about everything else that's on here. But I'm going to tell you this. Once you master that and you understand how to identify on your chart, qualify swing high and qualify swing lows, you will be able to start to understand how to track ADR. Once you master ADR, you'll be able to see sell side and buy side. Now, do you don't even need to master ADR to read where the buy side and sell side liquidity is? For me, buy side and sell side liquidity are nested around qualified swing highs and qualified swing lows. If you don't know how to identify this, you cannot even mark out your liquidity level. I'm not going to let you get away with like many ICT traders like to do where they say, I'm trading buy side and sell side liquidity, and they just say, oh, some swing, right? How do you qualify that swing? Have a mechanical process where I identify specifically. I wouldn't say mechanical, but I have an objective and very clear defined process to identify qualify swing high and qualify swing lows. I know how market structure is supposed to look like within Arcane concept. So this is the foundation because it allows you to define your range, it allows you to define liquidity, and it also allows you to define order blocks, right? The order block will be nested within the qualified swing high. Once you identify your swing high, that's where your order block will be nested and located. Once you identify your order block, you can also identify your breaker block. Okay, the breaker block will also be found at the point of reversal where you have continuous higher high, higher low, higher high, higher lows, essentially qualify swing high, qualify swing low, qualify swing high, qualify swing lows, and then pass take out the last swing and then creates the reversal while also closing below the previous swing low that initiated that sweep of liquidity on the buy side. Everything is objectively defined, right? But the overall understanding and concept is similar. Next up is going to be fair value gap. Obviously, these are going to be ICT concept. He's the one that essentially came up with this, but I added it on top of this because to be able to identify arcane breakers or unicorn breaker, I've interchanged the name in between those, but ICT said not to call his concept, to remix his concept and give it the same name. So I just decided to call it arcane breaker so people can differentiate since my identification process is completely different. Even the utility of it is a little bit different. So ABRK will be what that stands for arcane breaker. That's for that. Because this breaker right here, the difference between this and then this one right here is that we have a fair value gap on the sweep of liquidity. This one does not have, okay? Volume candles are very specific time-based candle that helps essentially create and confirm the distribution stage for a 15-minute candle body or 1 hour candle body as well. They're very, very important in the process of entry determination and also reading order flow. So if you don't understand where are the volume candle located, in order for you to read order flow within the Arcane concept, you're not going to be able to know how to read that order flow using my concept. MPL, major psychological level. Those are big number on the chart, right? I utilize these to be able to tell whether or not price has a strong draw or price does not have a draw, right? For my Arcane A plus model, this is going to be the primary way I'm identifying of my draw on liquidity when it comes down to my intraday model. If you don't understand MPL, you are going to be very much lost trading or going or watching the content that I create. Volume inverse gap. These are going to be inversion that are confirmed utilizing volume candles. And then high probability objective, this stems from measure psychological level. So if price fails to grab that level, those measure psych level, those level that ends with 20, 30. For example, if you look at NQ chart, levels like 23,000, that's a major psychological level. Levels like 19,000, that's major psychological level. Levels like 23,400. That's another major psychological level. There are level that ends with either 2 zeros or 3 zeros, right? These are the level that you want to pay close attention. These are going to be very much strong level that you can use as repeatedly use as strong draw on liquidity for intraday targets. If you're trying to not necessarily be on the high time frame to identify what the 4 hour is doing in relation to the 1 hour, to the 15 minute, to the daily, the weekly, whatever that may be, you go crazy. You don't want to do that. Make sure to master these concepts that I'm talking about right now, right? Because the MPL is the cheat code to that. So you don't have to jump into the high time frame and do all those analysis. And like I said, I already given out a lot of really good information in regards to how to utilize that as well. Once you have past failed to grab one of those major psychological level, that's when the major psychological level becomes a high probability objective. Not all MPL are high probability objective. All high probability objective are MPL. Make sure to understand that. That's very important. So now that I've given you guys a quick breakdown on this, and then you understand, in today's video, we're going to be tackling this. I have already made a bunch of video if you go to my playlist, there's a place on my channel for Arcane concept. There's already a video on QSH. There's already a video on order block and breaker block, right? I already made a video on Arcane breaker. I have already made a video on MPL and HPO right here. And I have already made a video on volume candle. There's already a video for my ICT playlist on FVG and IFVG. So if you go on my YouTube channel, you should be able to find most of these. The only video left is really this one right here, the Arcane dynamic range, as well as the liquidity one. And then I've already made also the video on VIG as well, volume inverse gap and then volume candles. I may make new video down the line just to further explain different ways how to utilize it, how to read order flow utilizing the volume candles and things of nature. But this is just to give you a visual representation that everything that you see on here is like a pyramid, right? They're built on top of each other. And the foundation of that, although I put qualify swing high here, is really this, right? This is the precision, right? Because if you don't understand how to use this, it doesn't really matter. Like you won't understand the foundation, some of the foundational concept here that you have, that you see here, but everything built on top of each other. And then we start from the top instead of the bottom here, right? So QSH, ADR, Basa liquidity order block breaker block, FVG, volume candle, and eventually unicorn breaker or arcane breaker, as I like to call it. With that said, any further delay, let's go ahead and jump into today's topic, ADR. So for you to understand ADR, you first need to understand structure. Like I say, I made a video already on structure. So if you already understand this, feel free to skip this video. But for those of you that don't understand structure within Arcane concept, I'm going to go ahead and break it down again. When you're identifying a qualified swing high or QSH, you first need to have a bullish expansion. So this is going to be the different stage to identifying, right? And then this image that you see right here represents that. But these are going to be the different phase of identifying a qualified swing high and a qualified swing low. So we're first going to start with a qualified swing high. For qualified swing high right here, you're going to need a rejection. What is a rejection? Let's go ahead and take a look at the next slide. A rejection here will be essentially a bullish candle. Let's say if you're looking at a bearish rejection or bullish rejection, I should say, it will be a bullish candle followed by a bearish candle, right? If you're looking at qualifying a swing high. In the case if you're trying to qualify a swing low, it will be a bearish candle plus a bullish candle. Simple as that. Okay? Does that make sense? Any questions so far? Right? Clear, right? Next up, an expansion leg. Okay? You need an expansion leg. Your rejection must come from an expansion leg, and this is very important. An expansion is simply two or more candle moving in the same direction. Let's say, for example, if you only had this two right here, this two last two bullish candle, that would be more than enough for expansion, right? You just need two candles or more that move in the same direction. Think about another example. If you had a bullish candle here, maybe another bearish candle in here, and a bullish candle, would this still be valid? Yes, it would still be valid. It would still be a valid expansion because you will have at least two bullish candles that are moving in the same direction, although you have one bearish candle in between. Let's take a look at another example here. If you had, let's say, this candle right here, bearish, and then you get a closure above here, would you have an expansion? Yes, you would have. Let's say that expansion would start here, you would have an expansion. Okay. So I hope that clarifies what an expansion is. And then the next step, you need a correction. Okay. You need a correction. So what is a correction? So this is what I really need you to pay attention because it's gonna get a little bit tricky if you don't pay attention to this. Expansion is typically gonna be the first phase, although I have it as the second phase. It's two or more bullish candle moving in the same direction. After you have an expansion, next up you're gonna look for the rejection. After two bullish candle, you're gonna look for a bearish candle that opposes that bullish candle, right? Once you get that, that's where you're going to begin qualifying if this is a QSH. How are we going to do that? The way you're going to do that is very simple. You're going to mark out the top, the highest point, whichever wick. So let's say if this bearish candle had the highest wick up here, you're going to mark out the highest wick of either of these two candles, and then you're only going to mark out the lowest on the lowest wick right here, the lowest point of the bearish candle right here. This candle, which is this line, is going to be called the expansion line. And then this line right here is going to be called the correction line, right? So the correction line and then the expansion line are going to be very crucial. The correction line is only going to be for the bearish candle, in this case, when you're looking to move bullish. And then the expansion line is going to be the highest point across both candles in that rejection set. Let's say if we expand first before we correct, right? If we expand first before we correct, then this is no longer potentially a QSH, right? Then it's no longer a QSH. No, 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 no. It's simply a pause in that expansion. That's all it is, right? Remember, two or more candle moving in the same direction without a correction is simply an expansion. However, if we do get the correction with another bearish candle that simply closes below, that bearish candle can close with a wick, it can close with a body. That's all you really need. So that means that you could have a bullish candle as long as you don't get a bullish candle that closes above here first. Because if you get a bullish candle that closes above here first before we correct, then you have to look for another bearish candle next to it and then mark the top of that and mark the low only of the bearish candle and then track for the next correction. It's a bit tricky. I know if this concept is new to you, it's going to sound a little bit like Chinese or like some, alien language or whatever that may be. But I'm telling you, please play this video over and over. And once it click, I'm telling you, you will never unsee it. If you learn to read structure with these mechanics, I promise you, you will never trade the same. I'm going to repeat this again. You mark out the top of the rejection across both of these candles right there, right? That's the expansion line. And then you mark out the lowest point of the bearish candle only. For a correction to happen, you need another bearish candle here to close before we get a bullish candle closure above this line. Why? Because if we get a closure of a bullish candle above here, and that bullish candle could be a wick and it could be a body, it doesn't really matter. The moment you get another bullish candle close above here, you literally need to track for the next bearish candle, and that's going to be your new rejection where you're going to identify the expansion line and then your correction line. Okay? So I hope the correction phase now makes sense because that correction phase is what's going to qualify this as a qualified swing high. And then the same is true for the qualified swing low. Qualified swing low, you're going to do the exact same thing. You're going to look for the expansion first, two or more bearish candle moving in the same direction. So right here, we have that. And then after that, you're going to look for a rejection. In the case of a qualified swing low, it's going to be a bearish candle plus a bullish candle. Since we are expanding to the sell side, when you mark out the lowest point in between those two candles right here, this is going to be our expansion line. and then only the top of the bullish candle now. Here it was the bearish candle, now it's the bullish candle. And what you want to see is the bullish candle break above this bullish candle before we break below with the bearish candle here, okay? If you get that, then you will have a correction and then a qualify swing low. And ladies and gentlemen, this is the foundation for our pyramid array matrix. Every single thing that we talk about will build on top of this. So I hope that makes sense. If you have any question, let me know in the comment section down below. That's it. Let's go ahead and move on to ADR. What is an ADR? I'm going to zoom into this picture so you guys can see. ADR is very simple. An ADR is an arcane dynamic range. A bullish arcane dynamic range are created whenever price expands from a qualified swing low to a qualified swing high with a displacement of a balanced displacement of a fair value gap and then price remaining inside of that range. Once you have that, that's when you have an ADR, a bullish ADR, but to be precise. Let's take a look at this example here. As you can see, we expand to the sell side at first here, right? Bearish, 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 and then bullish. This bullish candle get close above here. This is the correction line, and this is the expansion line, right? Do we correct first before we expand? Yes, we did. Since we do, this will be our QSL. And then price keep expanding, right? And then we create what? Another potential qualified swing high here, right? Why? Because we have bullish, bullish, and then bearish. The top of this bullish and bearish candle is our expansion line. And then the bottom of this bearish candle only is our correction line. Now, do we close below the correction line before we expand? Yes, we did. Therefore, this right here is our, let me make sure that I mark it here, qualify swing low, and this is our qualify swing high. What is the next phase? We need to have a rebalanced displacement in our range, right? What is the fair value gap that we have here? We have a fair value gap right here. Price has created in this range. We have another fair value gap right here. Price has created in our range. These are the two gaps that we have. Does any of these gaps get rebalanced? Right? We did the rebalancing right here. See how when we created this swing high, on this correction, we rebalance this gap. That means that the gap right here, this gap just gave us the confirmation for ADR. So that means that now we have our discount and premium level. So from 0 all the way here to 5 or 0.5, this is going to be our premium level. And then from 0.5 all the way to 1, this is going to be our discount. This is going to be the discount, and this is going to be the premium. And that's ADR, okay? So this is going to be the example of a bullish ADR. Let's go ahead and take a look at an example of a bearish ADR. Same concept. So when you have a bearish arcane dynamic range, it's when price expands from a QSH to a QSL with a rebalanced displacement and price remaining inside of that range. So let's take a look at this. We have a qualified swing high right here, right? Bullish, bearish, and then bullish. We have at least 2 candles or more moving in the same direction. And then we get an opposite candle, which makes this our rejection sets, right? The highest point in that rejection set just so happened to be the bullish candle actually, right? Right here. And then the low of the bearish candle, which confirm first. Do we get this is the expansion line right here, and then this is our correction line. Do we expand before we correct? We correct it first before expand it. So therefore, this is a QSH. We keep expanding to the sell side right here, right? And then we have 1, 2, and then 3. This candle right here, and then this candle right here. These 2 candles are our rejection. The lowest point, which is right here, is our expansion line. And then the top of the bullish candle is our correction line. Which happened first? Did we correct first before we expanded? We did correct first before we expanded. Therefore, this is a QSL. And this is our QSH. Did we follow those rules that we said earlier for the definition? We got a QSH followed by a QSL, and then with the displacement inside of the range that was rebalanced with price remaining inside of that range. Okay, so we have a QSH right here, we have a QSL, we have our displacement right here, we have another displacement right here, and then both got rebalanced. And then we can see clearly our discount and then premium level. This is going to be our discount, and then this is going to be our premium level. Very simple. Why is it important for you to make sure that price actually rebalance the fair value gap? Here's where I'm going to talk about the purpose of those ADR, okay? When you identify this ADR, it almost instantly gives you a bias, especially when you have a gap inside of it. It gives you already a bias. What do I mean by that? When you have a gap inside of it that's already been rebalanced, and then you also have the ADR, literally, it's essentially anticipating that we're going to continue moving in the same direction. So in the example of a bearish ADR, you have a qualified swing high right here, right? You have a qualified swing low right here. If you have a gap right here inside of your range, let's say, for example, in this case, and then we do not rebalance any of these gaps, meaning that price creates a qualified swing high and we stay below this gap. And then you're trying to trade continuation. Let's say if you're trading ICT, right? You're trying to trade continuation. Which one is more likely to happen? Is it more likely that you're going to create a continuation to the sell side and take out this low to create a lower low, right? Which is going to be another qualified swing low, and then leave this as a qualified swing high, or price is going to first try to rebalance the inefficiency created on this displacement right here first. That's the reason why I require that displacement to be rebalanced. You can utilize those range as a form of for people that are, for the ICT trader here that have a little bit more experience, trading in the form of an IRL to ERL, okay? But with structure, because let me say something to you. You cannot just randomly pick a random IRL to ERL. I'm going to give you an example. If I were to remove all the price action moving past this level right here, you could say that price just tagged this IRL right here, and it might be moving lower, right? But is this a qualified swing low right here? No, it's not. See this candle right here? Bearish, bearish, and then bullish, right? We never get another correction that's bullish above here, right? Before we tag this gap to try to essentially anticipate moving lower. So it simply rebalances. So that's the difference between an IRL to ERL. But if you use this foundation as a bias identification or as a bias to build your intraday bias, or even build your pre-market bias, right? You can come into the market if you don't see this structure, let's say, for example, on the 4 hour, even on the 15-minute time frame, I would say. I wouldn't really go as far as to say the daily or the weekly because I have not really used my concept on that have a time frame. It mainly work as a swing trade, maybe like a day or two type trades, or maybe an intraday for the most part, because you're trading immediate structure. And price will respect this structure because this is how price move efficiently. When you see this range being formed, what you're looking for essentially is a high, low. You're literally trading pure structure. High, low, and then obviously lower high, if you're in the case of a bearish scenario here, lower high, and then lower low. But for this lower high to be a high probability, it needs to make sure it rebalance any of the gap that was created when we created this first expansion right here. Because if we do not, you can almost predict where the turtle soup or where the sweep of you're going to be essentially liquidity for the rebalancing of those gaps, right? Meaning that if price expands from here to here, and then we pull back here, and you're trying to trade back down here, and then though the regional gap has not been filled yet, and you're just trying to trade back down, like you're gonna get swept, right? Because price is gonna use you as a liquidity level to take you and take you out higher. A lot of traders sometimes what they'll do, 9:30 will happen, and then they'll see some massive wick, but price will not touch any gap. And then they will start thinking, well, maybe it's moving down that direction. Maybe you should start trading. And then they get into some crazy dumb trade. And next thing you know, it turtle soup them and then move in that direction. And then they try to like buy at that point and then don't understand the context of whatever they're trading. That's the power of ADR. For accurate range validation and reliable continuation logic, the ADR must rebalance at least one of the internal fair value gap in that expansion. This rebalancing also serves as an indication of the efficient liquidity run. If you have watched my video on efficient liquidity run, you kind of see how now it overlaps with some of my other concepts that I have put together within the Arcane concept library. Efficient liquidity run, right? Efficient liquidity run behavior is when you don't have any untapped gap in between your entry and then your draw. When you see this type of thing usually happening, it usually tells you that, right? It usually tells you that, okay, price move from here to here, and then it takes you down, it takes you further down. But before it does that, see how it's rebalancing this. So if it moves even lower, and now maybe tag a hop down from key level here, when you're getting ready to reverse, if this was your original draw, you can now see how all the gap along the way will be rebalanced. Price will not have left any fair value gap that have not been rebalanced because every structure from this point all the way down here, swing high to swing lows, has rebalanced all the inefficiency inside of the structure and inside of the ADR. So you can use the ADR to build a pre-market bias. And what I mean by that, I mean that if you come to the market and you see this structure, literally, and then it's on a 4 hour, for example, and then this candle right here represents the 6 a.m. to the 10 a.m. candle, you can anticipate what the 10 a.m. to the 2 p.m. candle will look like. So if this right here is, we're on a 4 hour time, I want you to imagine this is on a 4 hour time frame. And then this is sitting at 6 a.m., right? Let's say it's the 6 a.m. to 10 a.m. candle. So you're at 9:30, right? So you can almost anticipate, okay, if we're inside of this range, I already know where my draw is. It's going to be the sell side right here. This is my draw. If I have this formation on the 4 hour, if I have this formation on the 15-minute time frame, your draw, if it's a bearish range, it's always going to be the low of your range. If you have this formation on the 15 or the 4 hour and it's a bullish range, your draw is always going to be the top of your range. Simple as that. So what you will do next, once you have that, let's say our draw here is a bearish. If it's just the 4 hour, that means that when the next candle begins printing, I can essentially anticipate either manipulating higher, maybe tag this gap again, and then flip back down and then begin delivering. So on the 1 minute or on the 15-minute time frame, I'll be trading some type of CISD or some type of arcane breaker or some type of breaker block or order block, which forms here maybe with SMT at these highs. And I'm anticipating this next 4 hour to print bearish because we already corrected now. I'm anticipating the rejection to be forming here on the 4 hour because this is going to be bullish. Now this is going to be bearish. And I'm anticipating what? The next candle here to be bearish and then continue just holding my trade until this structure gets completed. I essentially have traded high, low, and simply traded the formation of the lower high and then the creation of the lower low. I'm simply trading this expansion leg right here. You can take this ADR and then utilize on the 15-minute time frame to literally have a set bias pre-market. If you memorize and burn this image in your head. This is really all for today's video. Down the line, I may make a volume 2. If you guys want me to make a part 2 of this, where I can show you some example of how I'm utilizing this concept with my fusion model, which is my swing trade model, utilizing this. Please let me know in the comment section down below. I'll be happy to do so. I want to make this video extremely long because this is already a relatively long lecture. So I really, really hope you guys gotten a lot of value learning about this ADR model. So with that said, if you have any question, let me know in the comment, like I say again, and make sure if you gain tremendous amount of value, like, share, subscribe, and share this with a fellow trader that you believe may gain tremendous value learning about this. This was literally the cheat code for me the moment I unlocked this and I understood the concept that I'm building are actually adaptable regardless of the market conditions. So no matter what happened in the market, like I'll still be using this type of concept because it's pure market structure, price action. That's it, and it's organized and it's efficient. So it's a mix of pure market structure concept, obviously with a lot of other things that I essentially put together via my years of data gathering and also a little bit of ICT concept and smart money combined. But I try my best to put it down in a way where it makes sense for people that are trying to learn and then find ways to implement this in their own trading. I hope you guys gain tremendous value from this. Really, really help you get to the next level. That is my hope, my goal. That's all for today. I'll see you in the next video. And until next time, please stay safe and stay in profit. Sign out.